401k versus index fund investing. Planning for retirement is a necessary course of action these days and always. From COVID-19 lockdowns, rioters burning down cities, and crime rates soaring across the country, it's best to start preparing now. There are different options when laying out a retirement plan, but for most people, the choice comes down to a 401k or investing in an index fund. Today in this video, we take a look at both to help you decide between a 401k or an index fund. What is a 401k? A 401 is a type of retirement plan that can be offered by an employer. And if you're self-employed with no employees, you can have a similar account called a solo 401. These accounts allow you to contribute a portion of your paycheck for self-employment income and choose various savings and investment options such as CDs, stock funds, bond funds, and money market funds to accelerate your account growth. Traditional retirement accounts give you an immediate benefit by making contributions on a pre-tax basis, which reduces your annual taxable income and your tax liability. You defer paying income tax on contributions and account earnings until you take withdrawals in the future. Pros of a 401k plan: federal legal protection. Qualified workplace retirement plans are protected by the Employee Retirement Income Security Act of 1974, or ERISA, a federal law. It sets minimum standards for employers that offer retirement plans and the administrators who manage them. When you leave an employer, you have the option to take your vested retirement funds with you. You can do a tax-free rollover to a new employer's retirement plan or into your own IRA. However, be aware that depending on your home state, assets in an IRA may not have the same legal protections as a workplace plan. Dollar for hard-earned dollar. Many employers that offer a retirement plan also pay matching contributions. Those are additional funds that boost your account value. For example, your company might match 100% of what you contribute to your retirement plan up to 3% of your income. If you earn $50,000 per year and contribute 3% or $1,500, your employer would also contribute $1,500 on your behalf. You'd have $3,000 in total contributions and receive a 100% return on your $1,500 investment, which is fantastic. Always set your 401k contributions to maximize an employer's match, so you never leave easy money on the table. High annual contribution limit. Once you contribute enough to take advantage of any 401 matching, consider setting your sights higher by raising your savings rate every year. For 2021, the allowable limit remains $19,500 or $26,000 if you're over the age of 50. A good rule of thumb is to save at least 10 to 15% of your gross income for retirement. Most retirement plans have an automatic escalation feature that kicks up your contribution percentage at the beginning of each year. You might set it to increase your contributions by 1% per year until you reach 15%. That's a simple way to set yourself up for a happy and secure retirement. Cons of a 401k plan. Limited investment options. You may have limited investment options compared to other types of retirement accounts, such as an IRA or a taxable brokerage account. Your 401 or 403b may have fewer investment options. You won't find any exotic choices, just basic asset classes, including stock, bond, and cash funds. However, having a limited investment menu streamlines your investment choices and minimizes complexity. High account fees. Due to the administrative responsibilities required by employer-sponsored retirement plans, they may charge high fees, and as a plan participant, you have little control over the fees you must pay. One way to keep your workplace retirement account fees as low as possible is selecting low-cost index funds or exchange-traded funds or ETFs when possible. Penalty fee for early withdrawal. You must pay fees on early withdrawals. One of the inherent disadvantages of putting money in a retirement account is that you're typically penalized 10% for early withdrawals before the official retirement age of 59.5. Plus, you typically can't tap a 401 or 403 unless you have a qualifying hardship. That discourages participants from tapping accounts, so they keep growing. Now that you've seen the advantages and disadvantages of a 401k, let's take a gander at index funds. What are index funds? An index fund is a type of mutual fund whose holdings match or track a particular market index. It's hands-off, and you can build a diversified portfolio earning solid returns using mostly this type of investment. That's because index funds don't try to beat the market or earn higher returns compared with market averages. Instead, these funds try to be the market buying stocks for every firm listed on an index to mirror the performance of the index as a whole. Index funds can help balance the risk in an investor's portfolio, as market swings tend to be less volatile across an index compared with individual stocks. Pros of index fund investing: broad diversification. The most obvious benefit of investing in index funds is that your portfolio becomes instantly diversified, minimizing the likelihood of losing some or all of your money. Consider an index fund that tracks the S&P 500. This index fund would hold about 500 different stocks. While the performance of these 500 stocks fluctuates over time, investing in a fund that holds all of them matches your portfolio's performance to that of the index itself. Diversifying your portfolio among so many companies by investing money into just one index fund ensures that the value of your portfolio is not overly correlated with the fortunes of any one company listed in the index. Big returns. As Warren Buffett knew when he made his first $1 million bets, even the smartest and most diligent portfolio managers can rarely steer actively managed funds to beat index funds. Only about 23% of actively managed mutual funds outperform the S&P 500 over 5 years, according to research by Standard & Poor's. Other studies support this number as well. Individual companies both outperform and underperform the market. But, in general, the overall stock market increases in value over time. As a result, index funds yield generally high returns for low cost, which makes them an excellent value for any investor. Low overhead. The low costs of index funds are a function of their passive management. When managers are not spending their time and money researching stocks and or bonds to buy and sell for the portfolio, the costs in managing the funds are much lower than that of actively managed funds. These cost savings are then passed along to the investor. For this reason, look for the index funds with the lowest expense ratios. Lower expenses mean that more money is working for the investor, which provides the potential for outperforming actively managed funds. Keeping costs low is a key advantage of index funds compared to actively managed funds. Cons of index fund investing: low exposure. Because index fund managers must follow policies and strategies that require them to attempt to perform in lockstep with an index, they enjoy less flexibility than managed funds. Investment decisions on index funds must be made within the constraints of matching index returns. For instance, if the returns in an index are declining strongly, index fund managers have a few options in an attempt to limit those losses. In contrast, managers of an actively managed fund have more flexibility to act to find better performing options in good times or in bad. Not actively managed. Since index funds are not actively managed and most of the indices are market weighed, sometimes a stock that is performing too well gets higher weightage in the index. This creates a dependency of the fund on the performance of that particular stock. Low commissions. Since index funds have lower expense ratios, these are not that aggressively distributed as compared to active mutual funds. This is because the main income for mutual fund houses is through the expense ratio. Since index funds have a lower expense ratio or lower income for fund houses, mutual fund houses do not have much incentive in aggressively distributing these funds. Should you invest in index funds? Every investor should have index funds as a part of their asset allocation. First-time investors may also consider index funds as a stepping stone into the world of equities. In the short term, returns could be volatile, but over the long term, the fluctuations average out. To conclude, an index fund offers one of the cheapest ways to take exposure to equity markets. But before investing, do check if the fund matches your risk appetite. It's all about the level of risk you're comfortable being exposed to. While some may see a 401k as a safer, more traditional way to prepare for retirement, others may feel index fund investing offers a chance for higher returns and more comfortable retirement. Which one are you leaning towards and why? Give your thoughts in the comments section below.